Hi, welcome to Volatility 411. I'm Russell Rose from the Kelley School of Business. It's Friday, July 14th. We are very early in second quarter earnings season, and I'm going to talk a bit about earnings season and how the option market reacts to earnings. Now, you're probably thinking this is a show about VIX. Well, trust me, we'll get to VIX. So as I stand here, we've had four major companies report their earnings late this week: Delta Airlines, and then three banks today: Citigroup, JP Morgan, and Wells Fargo. They're all reacting a bit differently, but the one thing that they do have in common is the option implied volatility will be elevated going into earnings and then come back down after earnings. Now, how does this relate to VIX? Well, when the larger components in the S&P 500 report their earnings, we'll see the same thing. And the two largest components of the S&P 500, collectively about 15% of the index right now, is Apple and Microsoft. And if you take those two stocks, when their implied volatilities increase, that actually will bleed through to the implied volatility of S&P 500 index options through a trade that's referred to as a dispersion trade. Now, as VIX folks, we care because this will bleed through to VIX. And I often talk about the headwind that VIX will get on a 3-day weekend, but there is also a tailwind, a minor one, that occurs during earnings season and usually the last week of the month at the end of the quarter. So in this case, that would be the last week of July. But you're already seeing a little bit of a boost to VIX because we are at the very beginning of earnings season. So we'll keep an eye on VIX. We'll keep an eye on the big companies that are reporting earnings. And with all of that, I'm Russell Rhodes, and that's your Volatility 411.